In today's volatile markets, Warren Buffett's savvy strategy stands out. He suggests a bold approach, seize opportunities when others shy away in fear. This isn't about hoarding cash, but ensuring enough liquidity for intelligent investments. Buffett's history during market downturns underscores his talent for spotting value. In the 2008 financial crisis, when the S&P 500 nosedived by about 50%, Buffett saw opportunity rather than despair. He famously leans towards investing in robust companies, especially when their stocks are undervalued.
It's not quite as simple as having one or two formulas and then saying the market is undervalued or overvalued, or a company is undervalued or overvalued.
Such firms often recover robustly, offering lucrative returns for the discerning investor. His investment philosophy isn't about precise market timing, but consistent investment in quality businesses at fair prices. He warns against the allure of stagnant assets, noting that equities have historically outperformed cash. For example, from 1990 to 2020, the S&P 500 experienced an average annual return of around 10%, significantly outpacing the average savings account interest rates. Data supports his perspective on market resilience. Post-recession recoveries are a testament to this resilience, as seen after the 2007-09 financial crisis, where the market eventually surged to new heights. He urges investors to stay calm during market dips, relying on the proven ability of markets to bounce back over time. Start your money-growing journey with a free investing platform. Make a free account now and get up to 15 free stocks worth $2,000. You can also earn extra money on the cash you have not used to invest. Just click the link below to begin. Subscribe for more intelligent money tips and get ready to become an investing pro.